So what is price momentum divergence? Well, there are two main types of divergence analysis. Type 1 is regular divergence, and type 2 is hidden divergence. So we'll be defining type 1 first, and with bullish regular divergence we have price making a series of lower swing lows while the oscillator makes higher swing lows. And then for bearish regular divergence we have price making a series of higher swing highs while the oscillator makes lower swing highs. Typically, when we're talking about doing price momentum divergence analysis, we're doing that analysis between price and some momentum overbought, oversold type of oscillator, such as the RSI, which is the relative strength index, which we're using here, or the momentum oscillator, the MACD, the TSI, and dozens of others. We actually include 9 other custom oscillators that aren't included with the NinjaTrader platform, just so you can have access to several different types of momentum style overbought, oversold oscillators. So here at these lows, we can see that price is making a series of lower lows, while in fact the oscillator is making a series of higher lows. So that is our bullish regular divergence. And in this type 1 divergence, we're trying to measure when price is slowing down. So for example, the period in the RSI is set to 14 bars. That's the look back period for the RSI calculation. And RSI, relative strength index, is looking at essentially the magnitude of the down moves versus the up moves, so the down bars versus the up bars within that 14 period look back. It's obviously a bit more complex than that, but that's just a basic summary of how the RSI works. So now in order to better understand price momentum a bit more thoroughly, let's add an SMA with the same look back as the RSI. So we'll set it to 14 as the RSI is 14. And let's measure how many ticks per bar this SMA is moving down at different parts of this down move here. So for I'd say the maximum momentum to the downside looks like it's about 18 ticks, maybe 18 and a half ticks per bar. And then as we start to approach this first low here, we can see that that momentum starts to wane here. You see now it's about 12. And that's where we have the RSI making higher lows, but yet price is still making lower lows here. So it's right at that point that we begin diverging. We're diverging between price making lower lows and the RSI, or the oscillator, the indicator, making higher lows. So that's the first point at which we have bullish divergence there. We have price momentum divergence, indicating that price is slowing down to the downside. It's now not moving down as fast as it once was, and potentially coming to a low, maybe about to reverse to the upside. Well, then here, at the next swing down, we have momentum waning even more. You can see, during this correction back up to the upside, the RSI came back above 50. So it's almost kind of resetting here, and then as it comes back down, it's now not moving down quite as fast as it once was back here. And we're maintaining above the prior swing low in the RSI. So we have a series of higher lows in the RSI, while price is still making lower lows. And then we find support, and crude oil reverses back to the upside. Now let's move on to bearish momentum divergence, where we'll be looking at the swing highs in price relative to the swing highs in the oscillator. But before we do that, let's go ahead and remove the SMA. I added it simply to help try and explain price momentum. How back here, we're looking at how fast this SMA was sloping down, where we had very high momentum to the downside, and then it started to slope less and less as we approached this bottom, and the RSI started diverging from price. So the RSI is not actually using the SMA. I just wanted to use that to further explain price momentum. But now that we've done that, let's remove the SMA and now move on to bearish momentum divergence. So right here, we have our initial swing high in the oscillator. And then right here, we have a higher high in price, but a slightly lower high in the oscillator. So let's remove those vertical lines so you can see it better. So again, for bearish divergence, price is making a higher high, while the oscillator is making a lower high. And then here, even though we gap higher into this high, price is indeed making a higher high, but the oscillator is still making a lower high. And you can see that here, as it's just barely below the initial swing of the oscillator right here. Let's now move on to type 2 divergence, or hidden divergence, where for bullish hidden divergence, we're looking at higher lows in price and lower lows in the oscillator. Type 2, or hidden divergence, is likely a bit more difficult for most people to understand because we're not really looking for waning momentum, which we typically see at trend reversals. With hidden divergence, we're looking for typically trend continuation patterns. For instance, here with the bullish hidden divergence, we're looking for a higher low than the previous low, while the oscillator is coming all the way down to the oversold territory at that second swing low, which in turn is much lower than the previous swing low in the oscillator. So higher low in price, lower low in the oscillator. I've seen several different people teach hidden divergence or type 2 divergence. It's been written about in several different places, and it can be a fairly good signal and pattern, but I think to call it momentum divergence is a little bit misleading because we're not actually seeing waning momentum into this low. You typically see a very strong move in the oscillator down into the low for the bullish signal or up into the high with the oscillator for a bearish signal. So just to reiterate, bullish regular divergence or type 1 divergence is looking for lower lows in price with higher lows in the oscillator. And then bullish hidden divergence is looking for higher lows in price with lower lows in the oscillator. So type 1 or regular, we tend to see at the end of a trend, right at the reversal. And then type 2 or hidden divergence, we tend to see within the trend for a trend continuation move. Now, having made that generalization, there are, of course, exceptions to that, and here we see one where we have a lower low in price and a higher low in the oscillator. And what is that? That is bullish regular divergence, or type 1 bullish divergence. The majority of the hidden divergences, however, will typically be trend continuation patterns. Now let's finish up the type 2 divergence, hidden divergence, with a bearish hidden divergence signal, where we have price making a lower high while the oscillator is making a higher high. So in this bearish hidden divergence example, we've had a major reversal to the downside, followed by a very strong pullback where the end of the retracement, the end of the pullback, doesn't quite break above the previous high. But yet in the oscillator, that retracement is so strong that the oscillator finally reaches the overbought condition, breaking high above the previous swing high's value in the oscillator. So we have a lower swing high in price with a higher swing high in the oscillator. As you can imagine, developing an algorithm that would be able to find these divergence signals automatically for us would be a huge undertaking. There are just so many conditions and so many nuances to each one of these different signals that to account for all of them takes a huge amount of programming and testing and refining. However, after about 3 years in the making, we have finally done just that. with the release of this third version of the Divergences Pro software, we finally have the most accurate and fully customizable divergence solver the trading industry has ever seen. One of the main issues that we faced in developing this software was the extraordinary amount of calculations that we had to perform in order to achieve the level of accuracy for the capabilities that I was after and for the testing that I wanted to be able to perform. But with this 3.0 version, we are now able to solve for these divergence signals in real time on every price change across multiple time frames, accessing as many of those time frames as we want within Bloodhound without slowing Bloodhound down, and with the new Swing Finder indicator built in, which allows us to measure the different types of swings, whether those be minor, intermediate, or major swings, and then determine which swings we're going to be using to find these different setups. We've also included double and triple divergence signals so that you see here we have the first divergence signal here, and then we have the second one here. While we're making lower lows in price, the oscillator is making consecutive higher lows. So that's why we have the single and then the double. And if we had a higher low in the RSI that was higher than the previous, then we would have a triple. And all of those different signals are accessible for signal testing. And we've also added a new hidden to regular divergence signal, where here we have a bullish hidden divergence signal immediately followed by a bullish regular divergence signal, where price is making a lower low and the oscillator is making a higher low. So we have a hidden divergence signal immediately followed by a regular divergence signal for a massive move to the upside. These signals are somewhat rare, but mostly very, very accurate. And we've also added controls to the tool strip of the chart. So you click once to hide all drawing objects from the chart, click again to bring back the drawing objects on the oscillator, click again just for price, and then again for both price and the oscillator drawing objects. You can right click on that, open up the user interface to be able to turn on the setups, the triggers, or any other setting you wish to control from here. So we can turn on all of the active rays from the previous intermediate swings. We can show the labels for the type and the distance move in the minor swings. And then we can show all of the previous rays from the minor swings that were broken or are still active. And we can do all of that from here from this user interface. Now, the most important new feature that we've added to the Divergences Pro 3.0 has to do with the Divergences Pro Reader indicator, which allows us to read the divergence signals from all of the other charts into one instance of Bloodhound. So now, inside of Bloodhound, rather than having to load all of those other time frames and all the divergence indicators from all those different time frames, which would completely just bog down Ninja and take minutes to load, we can access all of those different charts via this new Divergences Pro Reader indicator. So in the next video, we'll go into more detail about the new features and the new Divergences Pro Reader indicator.